Okay, Carla, we've got a good number of people that have joined in, and probably more will be joining in as we go. But welcome, everybody. We're excited that you could be here today with us for this insurance overview, and I'm going to hand it off to Carla.
Thank you. Well, first off, thank you, just as Jane said, for joining us today. We started thinking about this insurance seminar a few months ago. And what we found happening over the last few years is that more and more questions are coming up about property and casualty insurance. And a lot of that has been born from the wildfires that we've had in California. And we've definitely been seeing more and more non-renewals. And that is, of course, of concern to us. And so we often turn to Brian Truett for questions about what is going on with the insurance industry and how should clients deal with different insurance issues. And so a little bit about Brian, and then I'll turn it over to him. So Brian, I think I met you about 10 years ago. A friend of mine and fellow advisor had a very serious fire in her house. And her house had to be completely rebuilt. It was not a wildfire fire. It was actually a fire that started in her garage, if I remember correctly, Brian.
Yeah.
And what I learned is that her insurer was being extremely difficult about the rebuild process. And even though Brian had nothing to do with the insurer involved, he stepped in, helped her, got the insurer to pay what they needed to pay to rebuild her house. And with that introduction, I sort of got to know Brian better over the years. He's become a real, like I said, a real asset to us. We often see him at the conferences and educational seminars that we attend, and a lot of advisors similar to us rely on his expertise. And even though he gave me this very professional bio, I've ignored most of it, but there was one piece of information that I did not know about Brian, which is he's worked in carpentry and in plumbing, which is maybe perhaps an explanation of why he's so good about looking at some of these issues. And before I turn it to Brian, I just want to say that if you have questions throughout the webinar, please do enter them in that Q&A that you see probably at the bottom of your screen. Jane Lang will be collecting those, and we'll be peppering the presentation with a few questions throughout. And then Brian has said he will be available at the end to answer more questions. So with that long introduction, Brian, let me turn it over to you. And again, thanks for joining us.
Thanks a lot, Carla. So this presentation is several presentations kind of pushed into one, because I was asked this year to do a presentation for the FBA on what's going on with law in California, but they also wanted to know some things about fire and property coverage. And then I tried to make this as client facing as I could. So usually when it's supposed to be mostly financial advisors who are seeing it. So if I go esoteric, Carla, reel me in, all right? So, but we have a major crisis brewing in the state of California right now. It's fueled by climate change, it's fueled by politics and law, and it's also fueled by the fact that most people really don't have an understanding of how their insurance works. And this is true for even people in the insurance industry that don't really understand it. And what has been a real eye-opener for us, and this is really starting in 2017, is that, I wrote, this slide comes from 2018 after the 2017 fire, where carriers had paid out $2 for every $1 they collected in premiums. That year, it was $18 billion in losses, and that's the year, that picture is Coffey Park. The entire neighborhood burned to the ground. Several other towns burned to the ground too, but that one got the most media attention. And you can see that 18, 19, and 20 were all really big fire years, and 21 has been a big fire year. We don't have the tally on the losses yet. But in 2021, the number for a lot of insurance carriers right now is $4 for every $1 that they've collected. So the carriers are very concerned about loss in California. And the 2017 fire changed perception of risk. So what we used to think of as, a safe place, for a house to be built changed. Coffee Park had no brush around it. There was no reason that we could see from aerial photos before and after why that community would have burned down. So, with firefighters and people who are experts. Homes on golf courses. We used to think if you're on a golf course, it's irrigated. Lots of homes have burned down on golf courses. And coastal influence, vineyards, roads. People will tell me, oh, I have a road next to my house, so we're safe. Or, stucco and tile roof. People think that those are non-combustible, but if you have embers, we've lost homes that were 10 miles away from where an actual fire was because embers had been borne by wind and then landed in bark next to a stucco home and burned it to the foundation. So the things that made us feel safe in California really don't anymore. This picture is of a fire. I think this was in 2018 or 19, and the fire jumped the Carquinez Strait. So the wind blew the fire from one side of the Carquinez Strait to the other in Vallejo. In 2017, there was a lot of issues with claims. And part of this was everyone was saying carrier bad faith, and it was a lot in the news. There was a lot of even news programs that don't usually talk about insurance were trying to talk about insurance because they were jumping on the bandwagon. The bad faith aspect of the allegations was mostly perception. But there was a lot of people who were underinsured, and thousands, 3,500 houses burned just up in Sonoma County alone that year. And so a lot of those people were underinsured, and that goes both to the carrier and to the insured. And I'll talk about that a little bit more. And their sheer volume of claims was enough to have delays, really long delays, because you can't just go out and get an adjuster. The carrier has a certain number of them to deal with the claims as they normally come in. So they were short-staffed. A lot of the people were disorganized. I do some pro bono work for the Financial Planners Organization on claims, and I found that people were submitting documentations that were very disorganized, and adjusters couldn't read them, so they were just putting it to the bottom of their pile. And there was a misunderstanding of the claims process, how the actual insurance policies work. And all of that led to a lot of dissatisfaction and blame. And, the old someone should do something adage came up. And so someone did. In 2018, the California legislature unanimously passed 3 seminal laws that have really changed the landscape of insurance. So now we have this climate change thing and all these huge fires, and now we have law. And the law changed the way that an insurance carrier pays a claim in a declaration of emergency. So a carrier now has to pay its full replacement cost plus any extended replacement costs, and I'll talk about what that is a little later, to cash out in a total loss if there's a declaration of emergency. And they can also pull money from other structures. They can take money from different buckets of money in the policy now for the replacement cost of the home to cash out. And the carriers would have to pay building code upgrade if there's any coverage for that in the policy, whether they rebuild or not. And then they expanded the loss of use provision. Some carriers only had 12 months, some were 24 months, but they said everyone has to give up to 36 months. And so this changed how the carriers were not only viewing risk, but also what their aggregate potential losses could potentially be in a declaration of emergency. So there's a lot of unintended consequences to these laws. The insurance carriers weren't priced to pay out by those rules. The carriers know to really, to a dollar, how many people generally rebuild or don't rebuild, and they know what their loss ratios are likely to be. 2017 just turned that all upside down, but they knew that they weren't priced to pay out. under those rules. Most carriers only pay you full replacement cost if you replace, repair, or rebuild. And so the carriers would have normally been, paying out actual cash value, which is a depreciated value for people who don't rebuild. There's a proposition in California, a longstanding law that says carriers can't increase their premiums without approval by the California Department of Insurance if it's more than 6%. So the aggregate potential loss went up for the carriers, but the premium couldn't go up. And so what ended up happening was carriers started exiting the market because they couldn't collect enough premium for what they thought their losses would be. That's where that $4 for every $1 comes in. And the admitted and non-admitted carriers, they started withdrawing from the markets, raising rates where they could. And Lloyd's left. They canceled every insurance policy that we had with them in Tahoe, Sonoma. They just got out of the market completely for us. Many carriers started introducing non-admitted carriers. So a non-admitted carrier is a carrier that doesn't file its rates with the Department of Insurance. And so they have to follow California law, but they don't have to file the rates or say they can raise or lower their rates however they want to, because they don't have a relationship with the state. So carriers started introducing these non-admitted carriers to try to get more premium, but then that sort of disappeared as well, because a lot of those houses and the non-admitted carriers ended up burning down. And now you have money that would normally be going into these types of carriers. It's drying up because the money for this is usually coming from investors and hedge funds and things like that, where they're hoping to make a profit on insurance risk, and they weren't making a profit on insurance risk. And so there's very few carriers writing homes in brush areas now. Another thing that happened is reinsurance carriers have raised their rates. So most carriers, when they sell an insurance policy, will turn around and sell some of that risk to another carrier. They have to if they want to sell more insurance in that area, in that state. And so the reinsurance carriers have raised their rates. And so admitted carriers are paying more for reinsurance than they were collecting for the insurance. And so, a lot of people lost policies just because of that. So you'll hear people say, well, I was with Liberty Mutual for 40 years and they canceled me. Well, what happened was Liberty Mutual lost its reinsurer, and so they had to cancel it because they couldn't keep the business on the books according to law. So these things are big events in the insurance business, and it's caused a lot of problems for people who are buying homes or trying to sell homes. And because there was all this chaos, the insurance commissioner in California issued some moratoriums over the last few years about canceling insurance. We're going to have a cool down period and no one can cancel insurance. These laws gave him the right to do that. And so that made carriers even more afraid that if they wrote a piece of business, that they could get stuck on it. And even if they wrote it 1 year, they couldn't get off the next, because our insurance commissioner could put a moratorium in place and that house could burn down after that. So there's been a lot of back and forth between the carriers and the Department of Insurance and the legislature, and this is a mess. Carriers have also moved to a monetary statement of loss. So instead of saying you have this amount of time, they're saying you can use as much time as you want, but we're only going to give you this amount of money for loss of use. And so a lot of the carriers have restricted their offerings. So this law was meant to get at carriers who had low payment, right? Who had low policies and didn't have very good coverage. The law was meant to affect those carriers. In fact, those carriers were fine with the laws because they don't have a lot of coverage anyway. And it's the broader form carriers and the carriers in the regular markets that have been most affected. And so they're not writing a lot in California. I threw this slide in here because I think that these laws were created by people who wanted some credit, and they didn't really understand the insurance business, and they didn't really think about what the unintended consequences would be. This is a mandatory consumer notice that our Department of Insurance requires every insured to have on a homeowner's policy. And you can see that you've got actual cash value here. You've got replacement cost, extended replacement cost. This is supposed to tell you whether or not you have these coverages in your policy, but it doesn't tell you how much you have or what it does or anything. It would have been a far better move for the legislature and the Department of Insurance to enforce disclosure on how insurance works than it would have to change the way claims works in a declaration of emergency, because no one can tell what they have from this document, and they're still using this document today, and people are still confused about what their insurance does. So are there any questions on any of that?
Brian, I'm not seeing any questions in the
Okay.
Q&A tab. So if any of you have questions, please feel free to just add them into the Q&A tab at any
Right.
time. Thanks.
I'll roll along, and then if you see one, we can always go back. So what's happened now, there's this plan in California called the FAIR Plan, and it's a partnership between California admitted insurers, that's insurers that are filed rates with the Department of Insurance, and consumers. It runs like a carrier. It's an insurance carrier, but it only covers fire, lightning, and smoke. And so there's a huge influx of business going into the FAIR Plan now, because they have to take pretty much everybody as long as it meets some really basic standards. And this is a problem too, because there's a 3 million aggregate total limit on the FAIR Plan. So even a 1.5 million replacement cost house could hit 3 million when you add their loss of use, their personal property, some other structures, and the actual value of the property. They only covers up to 10% ordinance and law, and that's within this 3 million. All of these things that are normally covered in a regular policy are all in this $3 million aggregate. So we're seeing a lot of homes in the Bay Area and California in general that just simply, this isn't an adequate answer to losing their insurance. And there's a lot of business going this way. This is what it looks like. So we had an AIG policy in place, and they lost the reinsurer on that area, and the client was paying about $2,500 a year, $2,463. The FAIR Plan policy is $4,000, and then we had to put another insurance policy next to that, what they call a companion policy, in order to have coverage for liability, vandalism, that type of thing. But these policies aren't even nearly as nice as the AIG one. The AIG one had $1 million of replacement costs plus 200% extended replacement costs. They had full sewer backup, and this policy was great, but AIG couldn't raise its rate, so they had to cancel the policy. So instead of AIG raising its rate to $5,000 or $6,000 and having a really full policy, these people had to move to a FAIR Plan. And Bamboo is a company that's just a little small company that came into California to take advantage of all these companion policies, because a lot of the major carriers don't want to write in certain areas because they're afraid they'll get drawn in on a claim. The California legislature and the Department of Insurance have made the insurance carriers think that they're whimsical and not dependable or steady in terms of their rulings. And so there's a lot of people who don't want to do business in the state of California now. And so you have these little carriers that could really just go bankrupt with a fire or without a fire. I mean, a bad storm in California could wipe Bamboo off the map. But we had to use them because they were the only carrier that would write this particular home. So I'm concerned about small carriers that aren't national brands, and I'm concerned about this FAIR Plan very much. I mean, and there's a lot of back and forth going on right now. In 2021, carriers are looking to maybe put in wildfire deductibles, like an earthquake deductible, 15%, but I've seen it floated at 50% of the replacement cost on wildfire deductible. There's an increased flow of business into these non-standard markets in the FAIR Plan, and that's a problem because it's not sustainable. The FAIR Plan is funded by carriers that do business in the state of California. As fewer and fewer carriers have a stake in California business, fewer and fewer carriers are funding the FAIR Plan. So it's growing while its funding is shrinking. And that's not going to end well. So there's sustainability issue, fewer players, higher costs, and the solvency issues. I'm very concerned about the FAIR Plan solvency. I called several times to talk about what they have in terms of assets. And their response was, our financials are sent out to member companies quarterly, but they're not available for public distribution. So they don't want to talk about how much money they have to pay their claims either. So this is a big concern for everybody. And it's largely being ignored right now in the state. And we'll see what happens. I don't know what the future holds, but this is the state of the nation in California with law, climate change right now. So what can you do to avoid cancellation? There's a lot of cancellations going on. First of all, insurance should be thought of as a catastrophic coverage right now. You do not want to be filing any kind of small claim. No water claims, no fence claims, nothing that's small. If you're going to file a claim with an insurance carrier, you got to think that it may be the last claim that you ever file with an admitted insurance carrier or a national brand. So be very careful before you file claims. A lot of times, if people are with a State Farm or an Allstate, something like that, you can't call that agent and say, hey, should I file a claim or not? They are obligated by contract to file it as a claim if you call to ask a question. So if anyone has something they think on the horizon that they might have a claim and they want to chat about it, I'm always available for questions. You don't have to buy any insurance from my office to get some advice on what you should do. Because if you call and they file something as a claim, even if they don't pay it out, it still goes on your record as a potential claim. We've had several accounts declined this year because people had claims that they even withdrew and the carriers paid no money. But because they knew there was something that happened, other carriers wouldn't even look at the home. You want to clear vegetation and install gutter guards, narrow mesh venting, no bark and planters within 15 feet. Carla had sent me over something from the Moraga Fire Department this week about they have all these ideas about fire resistant vegetation, and their clearance for planters with bark and things of that nature were 2 feet. But from an underwriting standpoint, we're looking at 15 feet now. We don't want to see we don't want to see any combustible type mulch or something like that. We want to see gravel. We don't want to see bushes that are touching the ground. We don't want to see bushes that are touching the house, overhang trees, things like that. We have a lot of video of houses burning down now because of all the Ring cameras and everything that's available. So our data on where fires come from and how houses catch fires is pretty good. So you also want to have high deductibles. High deductibles save you money in the long run, and it keeps you from filing small claims. So it makes a lot of sense. I usually say that you want a deductible up to the highest break point. So if you change your deductible from 1,000 to 5,000 and you save, $1,000 a year on your insurance or $800, and then you go from 5,000 to 10,000, it's $100. You stay at the 5,000, but you might not want to file a claim anyway. But there's no reason to keep going unless you're actually saving some money. And another thing we've seen a lot of is lapse of policy. So people forget that they have their credit card on file with their insurance carrier, and the time comes to pay the premium, the carrier sends out a message to you, you don't see it, it gets canceled. In times past, the carrier would just say, okay, well, we'll reinstate that policy. Now, if a policy lapses, they don't have an obligation to reinstate. And if it's in an area that they're no longer writing or they'd like to be off of it, but didn't have a reason yet to get off of it, they just simply won't reinstate. So take your insurance very seriously. It really is important to pay attention to it. Let's see. So this is a kind of a break here. I'm going to move on to like coverages and problems with coverage. Did anyone have anything on this that they wanted to ask?
Yeah, we had one, Brian. Actually, I think it might have been right at the tail end of the first section, asking you to maybe if you could walk us through some of the coverages.
On
I think it might have been slide 7, 6 or 7.
on the FAIR plan,
Yeah.
I'm going to go through the coverages here in a few minutes.
Okay,
So
great. Great.
I just I can go back to that slide though after if we want to
Okay.
look at it again.
Okay. I had one more.
Yeah.
And it's short of getting a surprise upon renewal. How does a homeowner assess his or her risk of loss due to fire?
Loss of the insurance. I'm going to assume it's loss of the insurance. You can't. The carriers they'll come out with a list sometimes of zip codes that they're going to get rid of, and so they'll usually try to give you 6-month warning. But you won't know what their internal underwriting is. There's really no way of determining it. Some carriers have gone through, Travelers, for instance, they're not canceling insurance in some zip codes, but they completely shut down 80 zip codes in California. So if someone lapses a policy in those zip codes, they can't get it back. So there's a lot of carriers, State Farm will, for instance, is writing in certain areas, but they have houses in certain areas, but they will not reinstate. So all you can really do is wait to see what your carrier does year to year. It's been very chaotic and hard to manage. So these next three slides are sort of what we do for people in the insurance business. And there's 3 core problems that we address. And this goes to why people don't understand how their insurance works. A lot of the problems with claims from the fires came from the fact that people just didn't really understand their insurance. So the first one is insurance doesn't keep pace with spending and lifestyle. There's this curve, and people will remodel their house, or they'll do a lot of things but never call their insurance company and tell them, hey, we just put a $400,000 remodel on this kitchen, or maybe they purchased an investment property, or maybe they have, from a liability standpoint, now they have live-in housekeeper or nanny or something. But a lot of the houses that were underinsured over the last few years were underinsured because people did remodels and never even told their insurance carrier. So insurance just doesn't keep pace with spending and lifestyle because people don't really consider their insurance that much. It's kind of in the background being paid on an automatic basis, and they don't think about it. And the second problem is that it's considered a commodity. So people will sometimes say, well, I'm going to compare these 2 numbers and the rates, and if whoever's cheaper, I'm going to go with that. So they'll do a little bit of calculus. And this is not really a commodity. This is a complex financial tool that's designed to keep you from major financial loss. And so really, it's not the cost of the insurance, it's what does it do is the real question. And the core problem number 3 is clients tend to believe they're covered because of the other 2. Most often they're not. So the only way to really know is to build out some type of an analysis. We use a spreadsheet, and that's our whole process is about analysis and how things are covered. Because even if you have a carrier that doesn't have the best coverage in the market, sometimes you can still bolster your coverage and make it better and take a higher deductible and be a better position if you do have a major loss. So those are the 3 core problems. And this continuum of insurance contracts is really what the insurance business looks like. So at one end, we have this $1 sign, and down in this section, we have carriers that have maybe no sewer backup or no extended replacement cost, or they won't rebuild to a new code, but they're charging very little money for their policies. And at the other end of the spectrum, you have carriers that will write you a check for cash if your house burns down, or give you a check for your full contents. They're very easy to get money from, and they have very broad form coverage, but they're a lot more expensive. And so in the middle, you have what we call the middle market. This is your carriers like, Safeco and State Farm and Allstate, a lot of those types of carriers, and they do a lot of advertising. But one thing that they've done over in the past is they know what their average claims are. So this is where you might see, $5,000 on a house for sewer backup, or 20 to 50% inflation hedge on a loss for a house, where they, if you're $1 million, they'll pay 1.2 or up to 1.5 if there's a demand surge. These carriers have figured out what their average losses are within about 90%. So anything that they're not covering is an outlier. And that's important because there's this bell curve here. And if you have an average claim with a regular carrier, if you have a little water come out of a drain and you're under $5,000 plus your deductible, you'll never know that you had these sublimits on certain types of loss. But right now we have a house that has a $250,000 loss on it because of sewer backup. And it's covered because we only write policies that have full sewer backup. But in an average claim, they may have only had $10,000. And so, or maybe $5,000 or something like that. So on an average claim, what happens is, they pay the claim and you think, gosh, those guys did a great job. And if you have you're an outlier and you have a major claim in the hundreds of thousands of dollars, you're in that 10% of people who are dissatisfied with their insurance carrier, but really don't have anything they can do about it because of the way the policy works. And so a carrier can still have a 90% customer satisfaction rate because only 10% of its clients are outlier claims. And it's really important to know when you see, oh, we have a 92% or a 90% customer satisfaction rating, what are they really telling you? What they're really telling you is there's outlier claims that they're not considering. Because when someone does a survey on how your claim went, they're asking about how your feelings are and would you use the carrier again. But if this person here had a $500,000 claim and this person here had a $5,000 claim, their opinions shouldn't be equal in the survey, but they are. So it's really important to understand that this insurance industry really does consider this. I've had carriers tell me that they're less expensive because they have lower coverage and we should want to work with them because we could sell more insurance policies. And then I say, well, what happens if the house burns down and I can't rebuild it for the client, right? They're not going to be very happy. So anyway, this is what the insurance business really looks like in a graph. And so I hope that makes sense. And I'm going to talk about some coverages now, but first I want to ask and tell you something that's really important. I've rebuilt many houses over the last 5 or 6 years and do a lot of claims work. And I can tell you straight that the most important thing in my life is things that are like this picture. My daughter drew this for Father's Day for me. It's in my office. And I've got a lot of things like this that I've digitized. And when I talk to people who lose a house, their biggest problem immediately, besides where am I going to live, is they're in mourning for things that they've lost. And you're at your lowest point and you're going to have to deal with things like replacing your furniture and rebuilding your house. But if you've lost the things that really mean a lot to you, it makes everything that much more difficult. So the message that I would have for anyone, whether it's a wildfire, a sewer backup, a regular fire that just happens in your garage, whatever kind of loss it is, be prepared. Have the things that are important, so at least you have pictures of them, or they're digitized. Or if your grandmother, gave you something from her grandmother, it'd be a good idea to have that in a safe deposit box if you can. And so I threw this in here because this is one of the things I really think about when I'm thinking about claims, and preparation for claim is as important as not having one. So when we go through an analysis of how they should be insured, we look at, this is the property side. So the first thing that we look at is title. does the person whose name is on the insurance policy actually have an insurable interest in the property? And you'd be surprised at how many people don't. Maybe they have an LLC that owns the property and they put it in their name, or maybe it's a trust, or maybe there was some changes in the family. There's all kinds of reasons why you might have the wrong name versus the title name. But if that's wrong, a carrier doesn't owe you any money. So you really have to be careful with it. We look for whether or not you have the correct policy form. Carriers will sell insurance policies if you ask for them. So if you ask for a homeowner policy, they give you a homeowner policy. If your house is rented to others, it needs to be what's called a dwelling policy. If you have a commercial risk, it needs to be on a commercial form. So the type of policy that you have makes a really big difference. But if you buy the wrong thing, the carrier isn't necessarily obligated to pay you in a claim if it comes out that you owned a homeowner policy, but there was a rental going on in that homeowner policy, which happens very frequently when people, they buy a new home and they keep an old home as a rental and they never update their insurance from homeowner to dwelling. Very common. I'm going to talk about replacement costs, but we saw a lot of undervalued homes. Extended replacement cost is an inflation hedge where they give you some extra money. I have a slide for that. Ordinance and law. All of these things are things that we capture in a spreadsheet. And so ordinance and law is a really big one. And when you rebuild a house, you have to rebuild to a current code, and it causes an unpredictable expense for a carrier. I had a job on a house that I owned that went from a $2,500 wiring bill to a $75,000 bill in about 10 minutes when I had it inspected. And so the carriers don't like that. So what they do is they say, okay, we're going to cover ordinance and law, but we're going to call it out as a percentage. So a fire might be your first cause of loss, and then the ordinance and law is a loss resulting from that. And so they're only going to give you a certain amount of money for that. It's misunderstood too, because people will remodel a house and the house will be to code, right? An inspector will have come out to the house and said, okay, you can button this up and you're all done, final inspection. A lot of code is grandfathered on a remodel because if you don't open up all the walls like the fire department does in a fire, then you get to keep some of the code that you have. But on a fire or a large loss with water or something where someone's opening up all your walls, now you have to comply with all of the current code. And it can be very expensive. So $1 million house home built in 1978, this is a very typical scenario where someone might have 10% ordinance and law coverage. The rebuild on a 1978 home is likely to be somewhere between 30 and 40% of new code. So that's $400,000. There's 10% coverage on that policy. The client is going to be out of pocket 30%. 40% is code, 10% is covered. It's $1 million, and the client has to rebuild their house, and they're out $300,000 because of that ordinance and law sublimit. This goes right back to that bell curve that I showed you. Carriers know that on average, people aren't going to trigger more than 10% code upgrade unless they have a really major loss. So they build these ordinance and law sublimits into a policy so that if you are an outlier, you have a major claim, the carrier has a way of not paying what they should have paid you. And these things are in the policies, but you have to really read them and find them. And most people simply don't even know it exists. A lot of insurance agents don't know it exists. Even more common, and this happened a lot in the Santa Rosa fires, homes are underinsured. $1 million home might be insured at $700,000, and now they're down to $700,000 or $70,000 of code coverage. And the client has to pay the difference to bring the house up to $1 million, and they still have the $400,000 of code, but only $70,000. And so now they're out $630,000 to rebuild this house. And most people simply can't do that. That's why so many houses did not get rebuilt in 2017. And that's why the California legislature was trying to fix these problems, but they fixed them without really understanding how the carriers think and how the carriers work. It would have been far better to go in and make this type of thing a lot more, have a higher burden of disclosure for this, where people had to sign off on it and understand it. But that's not the route everyone went. And it was everyone. It wasn't like, this isn't Democrat, Republican. It was a unanimous vote in the legislature. So this is a big one. We're talking about fire in California. The number one cause of loss in my insurance agency and in the industry in general is sewer backup. We've lost some houses to fire, but since I've been in the insurance business, sewer backup is the tortoise, the fire is the hare. Sewer backup happens in every season, in every county, everywhere in the country. And it's surprising how much it does happen. And people are always like, wow, I've never heard of that. But all it takes is a root ball out in an older neighborhood in the main sewer, or a lot of rain, or some kids put some stuff down a drain in a house, and then a washing machine and some other things go at the same time, and all of a sudden your house has got this black water in it. It's a very expensive claim. There's emergency cleanup, and porous materials have to be removed, and we have to treat anything that's non-porous with enzymes, and these claims add up really fast. And that's the reason that most insurance carriers in California only, and in the United States actually, only give maybe 5,000, 10,000. Some of them have no sewer backup coverage at all. It's an exclusion. So the carriers aren't putting this into their policy. Whether or not a carrier covers sewer backup is the difference in whether or not we will do business with them at my agency. So it's that important, because these are claims that I have all the time. Every year I have, maybe a $10,000 to $50,000 claim, two of those, and then we'll have a big one like a $200,000 or a $300,000 claim. And in 2021, I have one that's $250,000. We're going to have to redo the entire inside of a house. So sewer backup, something that's very important to have on your policy. Whoops. And liability insurance. So when we talk about liability, it's very important to understand that carriers have in their policy, our duty to defend ends when we've paid out the limit of this policy. So a lot of carriers, if they're faced with a claim that they know they're going to have to pay, won't defend. They'll just pay out the money that they owe on the policy, because why spend another $500,000 or $600,000 defending if somebody had a kid injured on their property and they know they're going to pay out $1 million. So having enough liability insurance, having some extra couple of million, if you have a $2 million net worth, having a $5 million umbrella puts the onus of defense on the carrier. They're defending their money instead of yours. And that's important. The form is as important in liability as it is in property. What kind of property form should you have? Is it a home? Is it a rental? Is it commercial? We see a lot of confusion on this. And the definition of liability, this is a big one. About 80% of policies that I review do not cover personal injury. And personal injury is libel, slander, false arrest. It is mental anguish. It is the thing that a personal injury lawsuit is made of. Someone gets injured, but they're really suing for their feelings. So a policy that doesn't have personal injury is malpractice to me. Any agent who writes a policy without personal injury is an idiot. And I say that plainly because it's really true. I see this all the time. And the reason this is the case is because personal injury used to be a part of a regular homeowner's policy. It was bodily injury, property damage, personal injury. And they stripped out personal injury because of social media. So many people are suing each other over things that they say about and to each other online, that the carriers started taking this out of their policies and then adding it back in by endorsement. But they never told anybody that they were doing it. And so people who don't read insurance policies wouldn't know that personal injury is not covered and you have to endorse it back. So This is a really important one. Every one of you can go, if you don't have personal injury on your policy, you can add it for like $15. It's not expensive. It just needs to be on your insurance policy. And uninsured motorist is a really big one. Overlooked and undersold. People, it's an extra expense, so a lot of salespeople don't like to talk about it. But if you were injured in an accident and needed care or had out-of-pocket medical expenses or non-network surgeries, things like that, you can go to your insurance carrier and ask them to pay what someone else doesn't have the money or the insurance to have paid. So this is very important. And people who have domestic staff, nannies in particularly, need to know if they have workers' comp insurance or not, because it's California law. If you've got a nanny or a housekeeper who works full-time, something like that, a lot of people these days have in-house staff helping elderly parents and things like that. This comes up quite a bit. So that's liability. And business exclusions. It's very important to understand that carriers consider Uber and Airbnb type things a business. It is a commercial exposure. So if you have a kid at college who's riding around as an Uber driver, your insurance doesn't cover that unless he buys specific commercial insurance for that. And the same thing with Airbnb. We see a lot of secondary homes where people put them on Airbnb. Carriers consider short-term rental to be the same exposure as a Marriott or a Hilton or something like that. Short-term rental, there's a few carriers that do it, but it's very important that you set up a commercial risk as it should be set up. So I'm not going to go into it too long, but I'm just going to say that if you're doing that, it's worth a conversation with somebody who knows about commercial versus personal insurance. And this is how it all comes together for us. We put everything into Excel, and I can give anyone who wants to build their own spreadsheet a template too. But so this spreadsheet here, we take everything, the mileage, their use, their annual premium, what their deductibles are. The big thing on this one, you can see he had his car titled to a professional limited liability corporation, but he had his insurance in his own name. So he was driving around really with no insurance because he had no insurable interest in the car. So the title and insurance didn't match. We fixed this. We ended up issuing a policy and moving the title of the car to him. It wasn't worth the tax break to not have the insurance correct. The other thing we did was we raised his deductible from 500 to 1,000, and that we gave him a more expensive policy, but because we bumped it to $1,000 deductible, it ended up being pretty close to the same premium. And he only had $100,000 of injury, bodily injury per person on his auto. We bumped it to $1 million. And here he only had 100,000 of uninsured motorists. And that's not very much. You could use that up in a day in a hospital. And we bumped that up to $1 million, and then we put an umbrella on it with some more. So this is an auto liability declarations page. And then we go, to a home one, and, his home was titled to a trust. So we added his trust as an additional insured. He had the right home form. It was in homeowner insurance, and he was carrying earthquake insurance. His deductible was $1,000, which we would have told him to raise anyway. We raised that deductible to $10,000. It ended up being about neutral on the premium. He's paying about $700 more per year, but he has a much better policy. The big issue here, he was insured for $176 a foot, and the house really should have been insured for more like $400 a foot. So when we started asking him about what was in the house and how the kitchen was built and the bathrooms, we knew that this house was underinsured. And he had extended replacement costs of 150%. So the way this works is if the house would have burned to the ground, the carrier would have paid out to 150% of this 677, but that only took him to 1,016,000. He really needed to be at 1.5 million to rebuild the house at all. So, he would have never been able to rebuild this house if it would have had a loss on it. Down here, we have another house that had 10% ordinance and law coverage, so we put full coverage on it. And now some carriers won't write full coverage. Maybe you can't get a carrier that has full coverage, but State Farm, for instance, they start out at 10%, but they will go up to 50%. So if you had a State Farm policy in an area where you couldn't replace your house, you could increase your ordinance and law at least to 50% to lessen your chances of being out of pocket on a major loss. So these are just little fixes that make a big difference. His sewer backup was excluded, and we brought that back in on a different policy. And his blanket property went up. That's your contents of your house. That went up when we bumped up the house value. And here he had an exclusion on personal injury. So this policy that he had been written on an old style, what's called an ISO form. It's Insurance Service Office, with a carrier that used its name and relationship to sell him a policy, but really he wasn't adequately covered and no one had paid attention to him. And he'd been going on like this for many years. So this is what the before and the after look like. But this is a way for you to really think about what your insurance should look like. Domestic workers' comp, he had a nanny, and we ended up putting a workers' comp policy on there for the nanny. He didn't have that contemplated under the policy. If the nanny falls down the stairs or something, and goes to the hospital, that's a really big deal. So anyway, that's the end of the slides, and I think we're at an hour.
We had a couple questions, Brian,
Yeah.
as you were going along here. Regarding avoiding cancellation of your policy, what if your neighbor will not clear their vegetation away from the fence or has a shed built too close to the fence?
I would start there by writing a letter to the neighbor outlining the danger, that there's brush along the fence line, that it's close to your house, and that you're very concerned because if your insurance carrier comes out, you could lose your insurance. I would send that in a registered letter to the neighbor. I might start out with a conversation to take their temperature on it. But if they say, oh, I'm not going to do it, then I would send a registered letter so it's on record that it's been discussed. Because if someone is maintaining an unsafe condition and it's called out, they can't say that they didn't know. A reasonable person in a neighborhood would reduce their vegetation if it was next to your house. So we've had this happen many times. And then if they don't do that, then I would take that letter down to the fire department and say, hey, I've got a problem with these guys. If this catches on fire, it's going to burn my house down. The fire department or the city may come out and give them an order to remove it. And if they don't do that, you're kind of in a pickle, but you've established that they do have liability for that. So if the house were to catch on fire and it was a result of having that brush there and you called it out, you do have some protection because you can say to their insurance carrier that has the liability coverage, I warned these people about this, and that would be a lawsuit that you might have to file. But these are sticky situations. They're really, if you get a neighbor that doesn't care or they don't think it's a big deal or.
You mentioned I'll ask one more question here and we'll wrap it up. The high-end carriers, who are those high-end carriers and where does like AAA fall into that mix?
AAA is right in the middle market, 150% of extended replacement cost. If you endorse it, you can have up to $10,000 of sewer backup. I think they'll do 25% ordinance and law. Maybe they'll do 50. They're right in the middle. They're not a bad carrier. They're right in the middle market. Their policy is designed for a specific type of loss. High-end carriers are carriers like Chubb, Cincinnati, Pure, AIG. They're carriers that that have very easy means of payment. They're, you know, cash out options and things like that. They charge a lot more money though than AAA. So the auto at AAA is going to be 30 or 40% less than the auto at Chubb, for instance. And the home insurance could be much more expensive too because of all the broad form coverage. And those carriers are really picky where they're writing right now. It's very difficult to get anything done. So, you know, if AAA is writing the risk, you may have a chance at changing the carrier because AAA canceled everything they thought was really risky about 2 years ago. So, you know, if you're a AAA client, you may have some options. There's some upper middle market companies that have really good coverage. Encompass is one that has full code upgrade, full sewer backup, 200% extended replacement cost. They're still writing in the area. Travelers was, but I think they shut it down. Safeco is also writing on a case-by-case basis, and they have a very broad form policy. They have what's called their Quality Crest product. They're writing that too. And they're an upper middle market carrier. They offer a little bit more coverage than the middle, but they're still middle in a way, if that makes any sense.
Great. I know we're getting to the close here, so we have a couple more questions. So I'm going to let Carla close and we'll continue answering questions after Carla wraps it up.
Yeah, Brian, just so everybody knows, Brian very graciously offered to stay on and continue to answer questions for those who would like to ask a question. Brian, for those who do have to leave, thank you so much for all you do. And I apologize, there's actually tree work going on right next to me. I'm hoping that they don't drop a tree on our house. And I have a funny anecdote. So my college age son wanted to do Uber this summer. And I called Brian and I got quite an earful about that. He did not do Uber after that. So
yay.
Yeah, thank you so much, Brian. For those of you who do have to leave, feel free to drop off. If you'd like to stay on and ask additional questions, again, Brian's willing to stick around. So thank you, Brian.
Thank you, Brian.
Thanks, guys. That's
Okay,
fun.
I'll just continue here. Let's see, where did we end off? Oh, there was a question about our personal liability and personal injury liability different?
They are. Personal injury liability is specific to, so if you see personal liability on an insurance policy, the question is going to be what it actually covers. A lot of those on a policy will cover bodily injury and property damage only, but personal injury may not be covered in that. The way you can tell is if you go into the definitions of the policy, a lot of times it will say, the definitions will say bodily injury and property damage are both defined, but personal injury will not be defined. And then on the liability, which is section 2 of any insurance policy, the first thing will say what we cover, and they'll say we will cover losses for bodily injury and property damage. And if it doesn't say personal injury, you know that personal injury is not covered. So it's by definition and by being silent on the what we cover on the beginning of section 2 on the insurance policy. And if you can't find that, send me it and I'll look at it for you. Happy to do it.
We have a question about Amica insurance, and the question is, will they offer high level of coverage on O&L, replacement, sewer, etc.?
No, Amica. So Amica is a carrier that is very well-intentioned and honorable carrier. But they are from a state that doesn't have as much code as we do. They're like people who are really well-intentioned that have no business doing business in California. So I think their max on sewer is 10,000, and I think 10% might be their max on code. But I would ask them, they're a direct writer, so you have to call and ask them specifically on that. But they will do exactly what they say they're going to do, though. If they say they're going to pay this amount, they pay that amount. They're honorable, but their policy is not broad form. And I think you have to endorse personal injury with Amica.
This is a great question. What kind of insurance do you have, Brian? Who is your carrier and why?
So I have Cincinnati Insurance, my insurance carrier. And for the last 20 years, I had Chubb. And when I bought a new house, Chubb would not cover my house. So Cincinnati did. And Cincinnati has about the same coverage as Chubb. They're an 80-year-old company in the United States. They have very white glove service and very broad form coverage. So I use them because I like working with them. They're probably my favorite carrier to work with. But you know, Chubb, Cincinnati, Pure, they're the three carriers that are still really doing work in California. AIG is in moratorium, but you know, I like the bells and whistles of, you know, what they do. You know, so like if I have an auto claim, it's agreed value. I don't have to worry about it. If I have, you know, I had a claim with Chubb when I lived in my previous house, and they did a fantastic job. You know, I didn't have to fight with them about anything, and you know, so those types of carriers are easy to work with. You know, in a middle market carrier, sometimes I have to, like Encompass, for instance, I've never had them not do the right thing, but sometimes I have to write them a letter what the right thing is, because they don't know that a contractor has to do a certain amount of work or something. So I don't know. Different carriers have different ways of doing things. You just have to know how to sail the waters.
So on that note, what kind of insurance do you carry? Personal.
Me?
Yes.
Well, I've got a home policy and an auto policy, and I have a lot of commercial insurance policies for my business and an LLC that I own. And then, you know, errors and omissions insurance. I carry a $10 million umbrella policy with, I think I've got $3 million of uninsured motorist in it. That's my biggest fear is not being able to work. So disability insurance and uninsured motorist coverage are very important to me. And then my home is insured to value, right? So I had it appraised for the replacement cost value of it. And so, but yeah, I have home, auto, umbrella. I'm not just the president of Hair Club for Men, I'm a member, right?
That's great. Well, so on that note, we have a great one here, asking if you're available to review our clients' insurance policies and give advice and guidance. And someone's ready to make an appointment here. So
Yeah, we'll do our first step is always to do an analysis, right? So what we do is we build the spreadsheet first, and then we go through that. And so anybody who wants us to build you a spreadsheet, we're happy to build you a spreadsheet. And the education is the first step, right? How does your insurance work? What happens in these types of different claim scenarios? And then we'll tell you what your options are. But if your option is you have to stay with a specific carrier, we'll give you notes exactly what to ask them for and how to ask them for it and see what they can do. So if there's a way we can be of service, we're happy to do it. So.
Are there any more questions? I think we've gotten to most of them here. We sure appreciate you, Brian, being here today. I know probably a lot of people are pulling their policies out of their file cabinets and taking a look. And also let you all know this will be posted on our website. So if you missed part of the presentation, give us about a week and it'll be posted on the HC Financial website. And if any of you are interested in having us take a look at that, please let us know. We're happy to do so. Any other closing comments, Brian, that you want to make before we sign off here?
Yeah, just that really, I mean it when I say if you come up with something that you think could be a claim or a situation and you want to have a talk with someone, sometimes having a talk with someone has no skin in the game is really useful. Because I don't care whether you make a claim with State Farm or not, but I do care whether you lose your insurance, right? Because I'm a fellow human. So I really want you to know that I'm available for that type of stuff, particularly for HC clients, right? I mean, we're very pro HC. you know,
Great.
so
Well, thank you so much. And thank you everybody for joining us today.
thanks.
Okay.